Let's get this thing popping. What's up, y'all? Unreleased music by Nomadic. Since he won't releasing any music, I would do it for him, piss him off, and get him to start doing some work. Let's go.
Won't you give me the rundown? Let me know how to love now. Let me know how to trust you.
Now just time for you to release some music. You said this summer. Let's get it.
Back to my crib. Write a chapter in my script. Tell a secret on my lips. Find out just how I like it. Yeah. When do you think we can link? Why don't you ring my phone? I don't need a quick fling, I need the real thing. If you ain't, leave me alone, no. I ain't gonna front you with my good luck. I've been waiting on it days and weeks. You were turning into my baby B. Like, have you ever thought about dating me? Basically, I'm tryna woo you, girl. Had you waking up thinking who you, girl? Bourbon Street, you a voodoo girl. Hide and seek, I don't wanna lose you, girl. 9 in the clip, 5 in the seat, 1 in the head. If they think they're gonna shoot you, girl, only bullets gonna come from Cupid, girl. And you can ask them niggas if they stupid, girl. Give me the rundown. Let me know how to love now. Let me know how to trust you. Show me nothing.
Come on in, hit that like button, hit that subscribe button.
To my crib, write a chapter in my script. Tell a secret on my lips. Find out just how I like it.
Waiting for it.
Give me the rundown. Let me know how to love now.
Facts.
Let me know how to trust you. Show me nothing else but you.
Flipper, what's going on? What's popping? What's popping?
Write a chapter in my script. Tell a secret on my lips. Find out just how I like it. Yeah. Girl, you know I rock the boat, baby. Bills paid, I'm responsible, baby. Cure you if you got the cold, baby. Lay down in my hospital, baby. I'm good as you ought to know. I'm unstoppable, they don't got to know, baby. We'll be somewhere tropical, baby. Playing so diabolical, baby. Oh, fatty on the island, fist full of diamonds.
Yeah, we about to have some fun on this one. We got the Fed meeting, baby. Oh boy. Crypto is crashing like a mofo. Stocks are doing good today.
Let me know how to love now.
All right.
Know how to trust you. Show me nothing else but you. Won't you come back to my crib?
Blue in the building. The Don. What up?
Find out just how I like it.
What up? Invest in crypto. What's going on, player? I'm doing good, man. It's a good day. Had to cuss out homeless beggar today, though.
Write a chapter in my script. Tell a secret on my lips. Find out just how I like it. Yeah.
What's going on? Good afternoon, beautiful people. I am Lando Success, your host for today. FOMO meeting. That's what it really feels like. FOMO meeting. Federal Reserve is basically having a meeting today, and they're going to address interest rates, hikes, what's going on, what's popping in the market. Are we going to create more doom and gloom? The overall goal, what we really want, is transparency and honesty. Because for too long, Jerome Powell been coming and completely lying to us. Besides just keeping it 100 and telling us completely what the deal is, man. Just kick it with us, and there's no need to keep on doing all that lying stuff. So that's what we want. But before we do, we have to go ahead and pay the bills. Get it out the way right now. Not right now, but right now. Drop exclusive bomb for my dog Moomoo, because they are doing the biggest promotion they ever did, where you can get up to 10 free stocks. Literally. Not 1, not 2, not 3, but all the way up to 10 free stocks. And I'm about to show you what all you need to do. And really, you just got to keep it funky and do it. All right, let's flip the screen over here. And they got it where all you got to do is, I can't find my original stuff. Where's my original one? But basically, they have it where once you do literally open an account, you are going to get free stocks. If you add $1 to the account, you're going to get 5 more free stocks. Here we go, right here. This is summer exclusive. This end at the end of June. So you get 1 free stock just by opening up an account. You're going to get 5 free just by doing any deposit. You do $1, you're going to get 5 free stocks. All of them are worth up to $2,500. A stock, somebody in Phoenix is calling me. I'm not answering that. And you can get more free stocks just by doing $100 deposit, $2,000 deposit, and some you got $8,000 to $2,500. Shout out to Moomoo. You guys are amazing. Great time to get started investing. Then also shout out to myself because we do have the Patreon active and going. So on the Patreon, we get it where we are talking daily about what we buy in the stock market. Shout out to Chris, called me at midnight last night to help promote it. But, you know, I answer for the Patreon members. Next goal to reach the 20 members, and we do giveaways every 10 members. The video I just did on inverse ETFs, people on the Patreon was able to know about it first. About Celsius, see, I can be more raw. And the Patreon price points by the dips. When it's time to sell, no need to sell. So I got a bunch of stuff, man. Some things I show to the public. But, you know, get that. You know, that's the link in the bio. All you have to do is click it. Now, how you guys doing today, man? What's popping with y'all? Sorry, the reason I got the glasses on today is because I have my lights and do this for enough hours. And I think I'm going to do a long one today. And the lights, you know, you just be stuck. See one bright ass light, man, that throw you off. And it's hot as hell outside. So hopefully we're going to go as long as we can. I also have my webcam up available too because I thought I charged my camera, but I didn't. So I have no idea when that's going to run out. But we going to get this thing popping no matter what. Our COR, what's going on, player? Newest Patreon member in here. If they raise the Fed by 75 basic points, will Bitcoin go down? Bitcoin is already going down. We're about to look at it. So let's go to crypto right now. First, go to crypto. Let's refresh it. Now, crypto is actually doing a lot worse than the stock market today because crypto was just down 7%, but it must be on a low run right now. It's down 4% overall. I'm assuming it's definitely on like a little small run. Let's see. Yep. Right here. Yep, because it was down 20,000. So right now, Bitcoin is 21,000. What up? There it go. That's crazy. Look how it just flipped that quick. It is down $20,500 a coin. Did it go under 20,000 today? Nope. It flirted with it, but it didn't do it. So Bitcoin is getting whooped on. The last 24 hours down 6%. Last week down 31%. That shit is crazy, yo. That is literally crazy. Ethereum down 9% and down even more, 40%. You see the prices is going crazy live. This is all live quick. Did Ethereum go under $1,000? Close. Made it all the way to 1,028. So on the Patreon, what we're going to probably do is do some buy orders soon. This is crazy. Cardano is actually in the green today. That's interesting. Shout out to Cardano. 46 cent opportunity. Solana under $30. Dogecoin is not down too bad. It's been stuck right about that 5 cents point. So I think that's the lowest it's been, 5 cents. So last day it's been staying around that mark. Shiba is only down 1%. FTX, surprise, FTX only down 2% because I know Crow is getting destroyed. After this video, I'm going to probably do a dedicated video talking about Crow and crypto.com because I have a lot to say about what I think about the future. Y'all know I'm a big, heavy Crow person. It's definitely going to be some FUD and not some good stuff, but yeah, no, I like to be first when I do my predictions because it's more than likely they are going to happen. ApeCoin is getting beat down the worst out of everybody. They're down literally 11% in the last 24 hours, down 46% in the last week. It's just bad. Federal Reserve hike rates by 75 point base in bold bid. Yep, so look like the Federal Reserve did end up going 75 points, which we actually expected. Well, we didn't expect it till like 2 days ago. Okay. Federal Open Market Committee. That's Federal Open Market Committee. Participate, gather at the so-and-so. Okay. Federal Reserve Market Committee. Okay. So here go the projections of what they're doing. So it's going to look weird, but we'll see. In conjunction with the Federal Open Market Committee meeting held on June 14th and 15th, meeting participants submitted their projections of most likely outcome of real gross domestic product growth, the unemployment rate, and so on. Now it's going to be a bunch of crazy random numbers right here, economic projections. So what we are looking at in this, in a long run, they want 1.8%. And right here, they saying in 2024, which is interesting, they have it a lot higher in 2024. Unemployment, central, the range, change. Look at this. So, right, how the real change in the GDP, that shit crazy how it shot up like that. That's the actual of it. Unemployment rate is down, but that don't really help anything. Inflation is up. So we really want to see when Jerome Powell come on, is he just going to keep it funky or not? Because I believe the market was prepared for this. So we expected it because they've been saying it for the last 2 days. Like, yo, it's going to raise, right? And you see the market is green today because we've been getting beat up so bad. It's like, it ain't too much more y'all can really do today. Now, it's not up heavy today, but it is. Fed hikes its benchmark interest rates by 0.75%. The biggest increase since 1994. Think of that, y'all. This is 2022. Some of you guys are watching this. Who in here has been born 1994 or lower? Literally, you wasn't even born yet. Some people in here. The Federal Reserve on Wednesday launched its biggest broadside yet against inflation, raising benchmarks interest rates 0.75 percentage point in a move that equates to the most aggressive hike since 1994. And then weeks of speculations, the rate seeks. I'm getting so many notifications. Market committee to benchmark range 1.5. Additional members indicated a much stronger path of interest rates increase ahead of arrest inflation, moving at its fastest pace going back to December 1981, according to the dot plot individual member expectations. Strongly committed of 2% inflation goal. The Fed moves comes with inflation running at its fastest pace in more than 40 years. Central bank officials use the funds to slow down. Now, what would be interesting, I actually did a video earlier. What was the inverse ETFs? So let me know if y'all watched that video. I talked about inverse ETFs, and I'm trying to think of what was the third one that I talked about, because it's one of them that literally cover. Here go the video.
With
And people worrying. Which one was it? TBT. I think TBT cover inflation. And you look at this, man, and year to date, this is crazy. So literally This was the share to buy, in my opinion. It's an ETF. For those that's not hip to inverse ETFs, it's basically the exact opposite of what the market is doing. So if you think everything is going bad, you can swap it out and come on over here and make a little bit of sense. So Jerome Powell should be going live in 15 minutes. Let me just set an alarm because we all get too excited and forget about it. 2:30. I got 2:30 a.m. That's not about to help anybody. But I'm not mad at it, man. Let everything keep on going down. Have you? I got my drink. Have you guys tried? So what's in there is the Simply Hard Lemonade. For a hot summer day, it's actually good. Isn't Ape doing like Ape Fest or something? Yes. ApeCoin is doing Ape Fest sometime this month, probably towards the end. That's why I think ApeCoin is a great swing trade at this point. You know, if you buy in, I just will buy in a lot and sell when it get its next spike. 92, baby. We got a 92. Shout out to 90 babies in the building. We got a few 90 babies. Nothing wrong with the 90 baby. You know, I'm an 80s baby. You know, we the OGs in the building. But, you know, everybody can't be an OG like us. I see down, NASDAQ, going up, Boeing. Chipotle. I just had some free Chipotle. I went out and did a Grubhub order, and a person didn't answer the phone. Bitcoin is on a rise. Hold on. Bitcoin is on the rise. So I guess they like what's going on with the market. See, look, down was 7%. And I just got a notification. Well, I guess it's delayed over here because it was a crypto.com notification. Crypto.com says at 21,800. So how the hell is it a whole $1,200 off? That's the crazy part. That's why I hate like so many different exchanges all say different things. So let's see. Let's say 26. Let's see what crypto.com say. Right here. Is that 29? 29 or 28? I'm trying to see. Why did I just get a notification? I don't know if my phone is quicker than everything and everybody else, but you know, it is what it is. We gonna see how everybody else react to it. All right, we have oil, yen, all that stuff down. Look at the sector performance, yo. All the way over here, commercial services is down 15%. Consumer durables 14%. Electronic, technology, finance, transportation. I'm surprised transportation is not the lowest, to be honest. Utility, the only thing that's up 22% is energy because of those crazy gas prices. That's crazy. Oil, gas, gold. Anybody in here investing in gold right now? Gold is a good option. I never did any gold just yet. Man, crypto just all red, literally. So let's look at what's going on in the crypto market before we do all our federal stuff. We got 9 more minutes. Shout out to everybody that's new in here. Hit that like button. Hit that subscribe button if you are not already subscribed. Breaking news, Bitcoin remains steady as Fed announces biggest rate hike since 1994. Coinbase layoffs include 8% of India team. OpenSea, Dogecoin price analysis. Following Celsius freeze, U.S. policymakers are high on alert for crypto Systemic. What did I say in my video? Yeah. I'm not gonna go on my conspiracy theories hat today. You're not about to piss me off. But this is all planned. That was completely strategic and planned because that hurts the whole crypto economy and ecosystem so much more than people really can understand when stuff like that happen, because the government could come in and say, hey, come on over to Death Row, player. Percentage of Ethereum addresses profiting from their position dropped in the multi-year lows. We didn't get to say goodbye. Layoff Coinbase employee, pick up the piece. Now I found yesterday, I was looking at one of the employees. I guess they found out when we found out that they was getting laid off. Like, that's terrible. Let me see if I can find it. Let's see if I can find it. Here we go. So this guy said yesterday, laid off from Coinbase today. It was a good run for at least for the last 3.5 years. It was cool to work across the organization from rebrand to the product. That's all said. Anyone looking for a sick, nasty designer, holla. So he was breaking down because this, a lot of people started retweeting it and stuff. And he had a lot of freaking options, man. I told him, let's see, did he reply to a player? Oh, no, it's just a spam doing spam stuff. So, yeah, that's interesting how, everybody is finding out that they was fired when we found out. After Coinbase abruptly laid off nearly a fifth of its staff this week, crypto exchange giants, many hundreds of affected employees have been exchanging tales of woes. Earlier this morning, messages amidst team drinks. Overall, the mood is anger, fury, and sadness. One former employee who wished to remain anonymous told Block, "We didn't get a chance to say goodbye." So, yeah, they just fire people, and you know how it go. Celsius appoints Citigroup to advise on possible solutions. So Celsius is just idiots, man. It's no easy way to put it. You can withdraw your funds at any time until you can't. So they dropped the ball big time, just messed up the bag, and they're trying to get advice from them because they might need to borrow some money. So they just messed up, such as they're robbing Peter to pay Paul right now. They're saying, hey, John, can you put in a 2-year Celsius, APY, lock up some crypto right here for 18%. Okay, here go 100,000. Then they gonna take my money and say, hey, Paul, it's time, here go your 50,000 we owe you. So they're literally robbing Peter to pay Paul, and it's absolutely terrible. I don't respect the move. I don't like the move. Seemed like everything got a lot darker. Probably need to hit that other light. That's what I'll probably do. Hit the other light. Shout out to everybody new in here. Lemonade sounds amazing right now. Yeah, it's hot as hell out here. It is definitely hot. Let me see. What's the weather today? It's bad. I got an alert. I got I think I screenshot. I literally just got this alert. It's a heat advisory. Basically saying it's hot as hell. Like for my ring, the little ring said heat advisory. Michigan is gonna be hot as hell. So yeah, it's burning up, man. It's burning up. Then I had to go off on this homeless dude today. What a finesser. So this is the real deal. This is the situation. Let me know if I'm wrong. Let's be honest. If I'm wrong, tell me I'm wrong. So the deal was I'm out going to go do an order, right? So we'll just say it's a Grubhub order. And I go in Allen Park. It's an area where it got like a Target, Chipotle, a bunch of food, bunch of things. And I'm pulling that stop sign, and Buddy is there with this big ass sign and 3 kids. So he there with a sign, 3 kids, and the sign, please help us, all that type of stuff. And the motherfucker had a Zelle. He had a cell phone number for a Zelle. So I'm like, bro, you obviously got a cell phone. You obviously got Zelle, and you obviously got a debit card. You're a functional adult, and you got 3 kids sitting right there. It's like, bro, I'm not giving you shit. So he come up to me and come up to the car. I was like, hey, hey, can I please get some? And I was pissed. I'm like, and because mind you, I'm out here picking up this $10 fucking order to go 6 miles, driving my car and hustling. And it's like, okay, me give you $5. So I'm being pimped by you at this point. So I'm like, bro, get out here and fucking go hustle. I'm like, you set an example for your kids. You out here begging people for money, and all of these stores will hire you to go pick up some trash or do something for them. And he literally just froze up, and he just, well, like that little fake scamming ass voice changed quick as hell. So let me know if I'm wrong. Like, I'm so tired of beggars right now. Now, if you got one leg and stuff like that, been in the military and got a bad deal, it is what it is. But right now, I'm not feeling no beggars right now. I'm like, man, I'm out here trying to invest in some more crypto. Let's see. All right. What's my favorite side hustle for money? It's always going to be the one that bring me the most money. And that is driving trucks. Driving trucks is not my favorite. Just make the most money. Like I can't say how much I get paid, but let's just say my last trip I drove from Kansas City to Buffalo. We would say I made well over $1.50 a mile. And, you know, it makes sense. You know, it's going to make the most money. But you got to fly. You got to be away from home. You got to cover your expenses. You got to know how to drive. You can't crash. You got to do things. You know, it's a lot more to it when you do that one. All right. Where is my Fed? Y'all ready to get this thing popping? 2:30. So we got 2 more minutes. Oh, no. Don't do that. Don't do a player like that. Man. But yeah, they dropped the bag right here. Senior commodity strategist suggests 20K Bitcoin may be the new bottom. Well, we will see. Polygon co-founder share his moderate optimistic take on the market cycle bottom. What you talking about, Willis? Co-founder share his moderate optimism. Polygon. We will witness panic and capitalization. I believe that. Technical analysis indicates agree. Some technical analysis indicates that are speaking in favors of what he said. Yeah, I think things won't be too bad. Yeah, alternate YouTube. Nah, we'll keep it right here. We can see what the market is doing. All right, my alarm just went off. 2:30. We are official. Now they should be getting it popping soon. So what I'm going to do is give my commentary. Oh, here we go. Once y'all can hear it, let me know you can hear it. So once he started talking, say I can hear it or something in the comments so I can make sure everybody is cool. Because I can't hear nothing right now. Here we go. You gonna keep it 100 or you gonna play?
Good afternoon. I will begin with one overarching message. We at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, The current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 of a percentage point and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in April, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core prices rose 4.9%. In May, the 12-month change in the Consumer Price Index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food, and is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. FOMC participants have revised up their projections for inflation this year, particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and 2.2% in 2024. Participants continue to see risks to inflation as weighted to the upside. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a half percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Oh, boy.
Thank you. Howard Schneider
He
with
looked
Reuters.
terrified, y'all.
Two related questions. Chair Powell, did you feel you boxed yourself in with the language you used at the last press conference on 50 basis point hikes in June and July? And would you please give us as detailed a sense as you can of what role you played in reshaping market expectations so quickly on Monday?
So, as you know, we always aim to provide as much clarity as we can about our policy intentions, subject to the inherent uncertainty in the economic outlook, because we think monetary policy is more effective when market participants understand how policy will evolve, when they understand our objective function, our reaction function. And in the current highly unusual circumstances with inflation well above our goal, we think it's helpful to provide even more clarity than usual, again, subject to uncertainty in the outlook. So, and I think over the course of this year, financial markets have responded and have generally shown that they understand the path we're laying out. Of course, it remains data dependent, and so that's what we generally think about guidance, and that's why we offer it. And of course, when I offered that guidance at the last meeting, I did say that it was subject to the economy performing about in line with expectations. I also said that if the economy performed, if data came in worse than expected, then we would consider moving even more aggressively. So we got the CPI data and also some data on inflation expectations late last week, and we thought for a while, and we thought, well, this is the appropriate thing to do. So then the question is, what do you do? And do you wait 6 weeks to do it at the next meeting? And I think the answer is that's not where we are with this. So we decided we needed to go ahead, and so we did. And that's really how we made the decision.
Okay, Gina?
Thanks for taking our questions. Gina Smilek with the New York Times. I guess I wonder if you could describe for us a little bit how you're deciding how aggressive you need to be. So obviously 75 today. What did 75 achieve that 50 wouldn't have, and why not just go for a full percentage point at some point?
Sure. So if you take a step back, what we're looking for is compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for. And by this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline. We've said that we'd be data dependent, focused on incoming data, highly attentive to inflation risks, the things that I mentioned to Howard moments ago. So contrary to expectations, inflation again surprised to the upside. Some indicators of inflation expectations have risen, and projections of this year have moved up notably. So we thought that strong action was warranted at this meeting, and today we delivered that in the form of a 75 basis point rate hike, as I mentioned. So what was the point of it really is this. We've been moving rates up expeditiously to more normal levels. And over the course of the 7 months since we pivoted and began moving in this direction, we've seen financial conditions tighten, and appropriately so. But the federal funds rate, even after this move, is at 1.6%. So again, the committee is moving rates up expeditiously to more normal levels, and we came to the view that we'd like to do a little more front-end loading on that. So I think that the SEP gives you the levels that people think are appropriate at given points in time. This was really about the speed with which you would get there. So as I mentioned, we 75 basis points today. I said the next meeting could well be about a decision between 50 and 75. That would put us at the end of the July meeting, in that range in that more normal range, and that's a desirable place to be because you begin to have more optionality there about the speed with which you would proceed going forward. Just talking about the SEP for a second, what it really says is that committee participants widely would like to see policy at a modestly restrictive level at the end of this year, and that's 6 months from now. And so much data and so much can happen. So remember how highly uncertain this is. But so that is generally a range of 3 to 3.5%. That's where people are, and that's what they want to see, knowing what they know now and understanding that we need to show resolve, but also be flexible to incoming data as we see it. If things are better, we don't need to do that much. And if they're not, then we either do that much or possibly even more. But in any case, it will be very data dependent. Then you're looking at next year, and what you're seeing is people see a bit more tightening and in a range of maybe 3.5% to 4%. And that's generally what people see as the appropriate path for getting inflation under control and starting back down and then getting back down to 2%. So 75 basis points seem like the right thing to do at this meeting, and that's what we did.
Steve.
Steve Leisman, CNBC. Thank you for taking my question, Mr. Chairman. You have not used the phrase in a long time, monetary policy is in a good place, which is a phrase that you used to use often. Now that the committee is projecting 4% or 3.8% next year in terms of the funds rate, which is similar to where the market is now, the futures market of 4% funds rate next year. Do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, Could you break that apart for me? How much of that is restrictive, and how much of that is a normal positive rate that ought to be embedded or not, in your opinion, in the funds rate? Thank you.
Sure. So the question really is, how high does the rate really need to go? And this is, the estimates on the committee are in that range of 3.5% to 4%. And how do you think about that? Well, you can think about the longer run neutral rate. You can compare it to that, and we think that's in the mid twos. You can look, frankly, at broader financial conditions. You can look at, asset prices. You can look at the effect you're having on the economy, rates, asset prices, credit spreads. All of those things go into that. You can also look at the yield curve and ask all along the yield curve, where is the policy rate? So for much of the yield curve now, real rates are positive. That's not true at the short end. At the short end of the yield curve in the early years, you don't have you have negative rates still. So that really is one data point. It's one part of financial conditions. So I think I have to look at it this way. We move the policy rate, that affects financial conditions, and that affects the economy. We have, of course, rigorous ways to think about it, but ultimately it comes down to, do we think financial conditions are in a place where they're having the desired effect on the economy? And that desired effect is, we'd like to see, demand moderating. Demand is very hot still in the economy. We'd like to see the labor market getting better in balance between supply and demand. And that can happen both from supply and demand. Right now, demand is substantially higher than available supply, though. So we feel that there's a role for us in moderating demand. Those are the things we can affect with our policy tools. There are many things we can't affect, and those would be, the things, the commodity price issues that we're having around the world due to the war in Ukraine and the fallout from that, and also just all of the supply side things that are still, pushing upward on inflation. So that's really how I would think about it.
But does 3.8%, 4% get it done? Does it get the job done of breaking the back of inflation?
I think it's certainly in the range of plausible numbers. I think we'll know when we get there, really. I mean, honestly, that would be, you would have positive real rates, I think, and inflation coming down by then. I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days, so I would think it would. But you know what? We're going to find that out empirically. We're not going to be completely model driven about this. We're going to be looking at this, keeping our eyes open and reacting to incoming data, both on financial conditions and on what's happening in the economy.
Thank you, Nick.
Thanks. Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that you like your policy to work through expectations, and now obviously this decision was something quite different from how you and almost all of your colleagues had set those expectations during the intermeeting period. And I know you just said that what changed was really the inflation data, the inflation expectations data, but I'm wondering, on the inflation expectations data, was there something you saw that was unsettling enough to risk eroding the credibility of your verbal guidance by doing something so different from what you had socialized before?
So if you look at we look at a broad range of inflation expectations. So you've got the public, you've got surveys of the public and of experts, and you've also got market-based. And I think if you look across that broad range of data, what you see is that expectations are still in the place, very much in the place, where short-term inflation is going to be high, but comes down sharply over the next couple of years. That's really where inflation expectations are. And also, as you get away from this episode, they get back down close to 2%. And so this is really very important to us that remain the case. And I think if you look for most measures, most of the time, that's what you see. If we even see a couple of indicators that bring that into question, we take that very seriously. We do not take this for granted. We take it very seriously. So the preliminary Michigan reading, it's a preliminary reading. It might be revised nonetheless. It was quite eye-catching, and we noticed that. We also noticed that the index of common inflation expectations at the board has moved up after being pretty flat for a long time. So we're watching that, and we're thinking, this is something we need to take seriously. And that is one of the factors, as I mentioned, one of the factors in our deciding to move ahead with 75 basis points today was what we saw in inflation expectations. We're absolutely determined to keep them anchored at 2%. That was one of the reasons. The other was just the CPI reading.
So if you saw a movement like that again, another tick up in inflation expectations, would that put a 75 or even 100 basis point increase in play at your next meeting?
You know, I'll just say we're going to react to the incoming data, and appropriately, I think. So I wouldn't want to put a number on what that might be. The main thing is to get rates up, and then pretty soon we'll be in an area where we're, I think, as you get closer to the end of the year, you're in a range where you've got restrictive policy, which is appropriate. 40-year highs in inflation. We think that policy is going to need to be restrictive, and we don't know how restrictive. So I think that's how we'll take it.
Neil.
Hi, Chair Powell. Neil Irwin from Axios. Thanks for taking our questions. The late-breaking kind of decision to go to 75 basis points, do you worry that that will make policy guidance a less effective tool in the future? And should we think of that as a kind of symmetrical reaction function if we start to get soft readings on inflation, or if the labor market starts to roll over?
To take your second question first, yes. I mean, I think we're resolved to take this on, but we're going to be flexible in the implementation of it. Sorry, and your question was guidance. So again, the overall exercise is that we try to provide as much clarity about our policy intentions as we can, because we think that makes monetary policy work better. It's always a trade-off, because you have to live with that guidance. And so you do it, and it helps a lot of the time. I frankly think this year has been a demonstration of how well it can work. With us having really just done a very little in the way of raising interest rates, financial conditions have tightened quite significantly through the expectations channel, as we've made it clear what our plans are. So I think that's been a very healthy thing to be happening. So, and I would hope that it's always going to be, any guidance that we give is always going to be subject to things working out about as we expect. And in this particular situation, we're looking for something specific, and that is progress on inflation. We want to see progress. We want to see inflation can't go down until it flattens out, and that's what we're looking to see. And if we don't see that, then that's the kind of thing that will cause, even if we don't see progress for a longer period, that could cause us to react. But we will soon enough. We will be seeing some progress at some point. And we'll react appropriately to that too. But I would like to think, though, that our guidance is still credible, but it's always going to be conditional on what happens. This is an unusual situation to get, some data late during blackout, very close to our meeting. Very unusual, to one that would actually change the outcome. So I've only seen, in my 10 years plus here at the Fed, I've only seen something like that, even close to that, one or two times. So I don't think it's something that'll come up a great deal.
Colby.
Thank you so much for taking our questions. Colby Smith with the Financial Times. On the clear and convincing threshold for the inflation trajectory, what is the level of realized inflation that meets that criteria? And how is the committee thinking about the potential trade-off of much higher unemployment than even what's forecasted in the SEP if inflation is not moderating, at this acceptable pace?
Sorry, the second part I didn't get.
What's the potential trade-off with higher unemployment than even what's forecasted in the SEP if inflation is not moderating at an acceptable pace?
Right. So what we want to see is a series of declining monthly readings for inflation, and we'd like to see inflation headed down. So, and right now our policy rate is well below neutral, right? So, soon enough we'll have our policy rate. Let's assume the world works about like the SEP says. The policy rate will be up where we think it should be, and then the question would be, do you slow down? Does it make you, you'll be making these judgments about, is it appropriate now to slow down from 50 to 25, let's say, or speed up? So that's the kind of thinking we'll be doing, and we're looking, ultimately, we're not going to declare victory until we see a series of these, really see convincing evidence, compelling evidence that inflation is coming down. And that's what I mean by, that's what it would take for us to say, okay, we think this job is done. Because we saw, frankly, we saw last year, inflation came down over the course of the summer and then turned right around and went back up. So I think we're going to be careful about declaring victory. But again, the implementation of our policy is going to be flexible and sensitive to incoming data.
Are you more concerned now that to bring down inflation, it's going to require more than just some pain at this point?
So again, I think that I do think that their objective, and this is what's reflected in the SEP, but our objective really is to bring inflation down to 2% while the labor market remains
Motherfucker
strong.
still avoiding the question.
I think that what's becoming more clear is that many factors that we don't control are going to play a very significant role in deciding whether that's possible or not. And there I'm thinking, of course, of commodity prices, the war in Ukraine, supply chain, things like that, where we really can't, the monetary policy stance doesn't affect those things. So, but having said that, there is a path. There's a path for us to get there. It's not getting easier. It's getting more challenging because of these external forces, and that path is to move demand down, and you have a lot of surplus demand in take for example in the labor market. So you have two job vacancies essentially for every person actively seeking a job, and that has led to a real imbalance in wage negotiating. You could get to a place where that ratio was at a more normal level, and you would expect to see those wage pressures move back down to a level where people are still getting healthy wage increases, real wage increases, but at a level that's consistent with 2% inflation. So that's a possibility, and you could say the same thing about some of the product markets where there's just excess capacity, and where the strong demand has gone into where they're capacity constrained, right? So you have effectively what we think of as a vertical supply curve or close to it. So demand comes in and it's very strong, and it shows up in higher prices, not higher quantities, not more cars, because they can't make the cars because they don't have the semiconductors. So in principle, that could work in reverse. When demand comes down, you could see, and it's not guaranteed, but you could see prices coming down more than the typical economic relationships that you see in the textbooks would suggest, because of the unusual situation we're in on the supply side. So there's a pathway there. It is not going to be easy, and again, it's our objective, but as I mentioned, it's going to depend to some extent on factors we don't control.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. So the new projections show the unemployment rate ticking up through 2024. Is a higher unemployment rate necessary in order to combat inflation? And what is lost if the unemployment rate has to go up and people lose their jobs in order to control inflation? Thank you.
So you're right. In the SEP, we have unemployment going up to the median is 4.1%. There are, of course, a range of actual forecasts, and I would characterize that if you were to get inflation down to, on its way down to 2%, and the unemployment rate went up to 4.1%, that's still a historically low level. We hadn't seen unemployment rates below 4% until a couple of years ago. We'd seen it for like 1 year in the last 50. So the idea that 3.6% is historically low in the last century. So a 4.1% unemployment rate with inflation well on its way to 2%, I think that would be I think that would be a successful outcome. So we're not looking to have a higher unemployment rate, but I would say that I would certainly look at that as a successful outcome.
Does that include people losing their jobs, or?
We don't seek to put people out of work. Of course, we never think too many people are working and fewer people need to have jobs. But we also think that you really cannot have the kind of labor market we want without price stability. And we have to go back and establish price stability so we can have that kind of labor market. And that's a labor market where, where workers are getting wage increases. Maybe the workers at the lower end of the spectrum are getting the biggest wage increases, as they were before the pandemic, where participation is high, where there's lots of job opportunities, where it's just a really, the labor market we had before the pandemic that's what we want to get back to. And you see, disparities between various groups at historic lows. We'd love to get back to that place. But to get there, it's not going to happen with the levels of inflation we have. So we have to restore that, and it really is in service in the medium and longer term of the kind of labor market we want and hope to achieve.
Hi, Chair Powell. Matthew Boesler with Bloomberg. So as you just mentioned, the committee is now projecting a 0.5 percentage point rise in the unemployment rate in the SEPs over the next couple years. And it removed a line from its policy statement about thinking that the labor market can remain strong while it tightens policy. You just mentioned that that is still your objective, though. So I'm wondering if you could explain why that line was removed from the statement, and also whether this means the FOMC is trying to induce a recession now to bring inflation down.
We're not trying to induce a recession now. Let's be clear about that. We're trying to achieve 2% inflation consistent with a strong labor market. That's what we're trying to do. So let me talk about that sentence. Clearly, it's our goal to bring about 2% inflation while keeping the labor market strong, right? And that's kind of what the SEP says. That the SEP has inflation getting down to a little above 2% in 2024 with unemployment at 4.1%. So, and this is a strong labor market. This is a good labor market. And as I mentioned, there are pathways to do it. But those pathways have become much more challenging due to factors that are not under our control. Again, thinking here of the fallout from the war in Ukraine, which has brought a spike in prices of energy, food, fertilizer, industrial chemicals, and also just the supply chains more broadly, which have been larger and longer lasting than anticipated. So the sentence that we deleted said that we believe that appropriate monetary policy effectively alone can bring about the result of 2% inflation with a strong labor market. And so much of it is really not down to monetary policy. It just didn't, the sentence isn't, it kind of says on its face that monetary policy alone can do this. And that just didn't seem appropriate, so we took the sentence out.
And given the new projections for the unemployment rate, could you talk a little bit about what accounts for such reduced confidence against, say, a month ago or 3 months ago that inflation will largely normalize on its own as these supply side issues get worked out? Thanks.
Well, yeah, I think you've seen, again, we've been expecting progress, and we didn't get that. We got sort of the opposite. So I also think the situation really since the consequences of the Ukraine war become more and more clear, what you're seeing is the situation getting more difficult. And you look around the world, lots of countries are looking at inflation of 10%. And it's largely due to commodities prices. But all over the world, you're seeing these effects. And so, and we're seeing them here. Gas prices, all-time highs and things like that. That's not something we can do something about. So that is really, and by the way, headline inflation is important for expectations. The public's expectations, why would they be distinguishing between core inflation and headline inflation? Core inflation is something we think about because it is a better predictor of future inflation. But headline inflation is what people experience. They don't know what core is. Why would they? They have no reason to. So expectations are very much at risk due to high headline inflation. So it's become, the environment has become more difficult, clearly, in the last 4 or 5 months. And hence the need for the policy actions that we took today, hence our resolution to get rates up and ultimately get them to where we think they need to be in coming months.
Thanks, Chair Powell. Edward Lawrence with Fox Business. I want to ask you, you talked about CPI going to 8.6%. The retail sales surprised the market by falling, and then revisions to the previous months were down. Are you hearing from contacts about consumers slowing spending or changing their habits?
So we're, of course, watching very, very carefully for that, and looking at the retail sale, the big store numbers and all that kind of thing. And so, but I think the fair summary of what we see is you see continuing shifts in consumption. You see some things sales going down, but overall, spending is very strong. The consumer's in really good shape financially. They're spending. There's no sign of a broader slowdown that I can see in the economy. People are talking about it a lot. Consumer confidence is very low. That's probably related to gas prices, and also just stock prices to some extent for other people. But that's what we're seeing. We're not seeing a broad slowdown. We see job growth slowing, but it's still at quite robust levels. We see the economy slowing a bit, but still growth levels, healthy growth levels.
So then as you are raising rates in this economy, how closely are you watching consumer spending, or is there another indicator that you're watching more closely?
It would be hard to watch anything much more closely than we watch consumer spending, but we watch everything. We watch business fixed investment, which actually has softened a bit, and we're responsible for watching everything. But consumption is 60-some% of the economy, 2/3 of the economy. So naturally, we spend a lot of time on that. And again, there's a lot going on. There are a lot of flows back and forth, but ultimately, it does appear that the U.S. economy is in a strong position and well positioned to deal with higher interest rates.
Thank you, Mr. Chairman. Michael McKee from Bloomberg Radio and Television. Are you targeting headline inflation now or core inflation? In other words, how far would you chase oil prices if they keep going up, if that's going to be the component that drives expectations? Would you risk recession for a headline rate if the core rate is holding steady or starting to go down?
So we're responsible for inflation in the law, and inflation means headline inflation. So that's our ultimate goal. We, of course, like all central banks do, look very, very carefully at core inflation because it's a much better predictor, and it's a much better predictor of where inflation is going, and it's also more relevant to our tools. As I mentioned, the parts that don't go into core are mostly outside the scope of our tools, so we look at that. But the current situation is particularly difficult because of what I mentioned about expectations. We can't affect. Really, I mean, the energy prices are set by global commodity prices, and most of food, not all of it, but most food prices are pretty heavily influenced by global commodity prices too. Also, other things. So we can't really have much of an effect, but we have to be mindful of the potential effect on inflation expectations from headlines. So it's a very difficult situation to be in, and we can't do much about the difference between the elements that make up headline that are not in core.
Could I just, as a follow-up, get a clarification on the SEP? When the members gave their forecasts, when were they inserted into the record? Were they revised after the CPI or Michigan numbers came out? In other words, does the SEP as we have it now reflect the same factors that led you to go to a 75 basis point move?
The SEP is of one piece. It reflects all of the economic readings. It also reflects the 75 basis point increase. This is important. So people had that in hand when their SEPs were submitted. So in other words, it's not in addition to what's in the SEP. The SEP, everyone's SEP reflects their thinking about this rate increase and what's going forward.
Hi, Victoria Guida from Politico. I wanted to ask about how you're measuring progress, especially since you've now started front-loading rate hikes more. You've talked about how you want to see inflation coming down over a series of reports, and I guess I'm curious whether you think inflation data itself is a really good indicator, or whether you might be concerned that it's a lagging indicator or that it might send confusing signals given that, as you've talked about, there are sort of supply and demand aspects. And I guess my question is, do you think that inflation data will tell you when you've gone to where you need to go, or do you just feel like maybe it's better to overshoot than to undershoot?
So I think the role that we can play, maybe the way to get at it is to say that the role that we can play is around demand, right? So, and we'll be able to see the areas that we can affect are those that are associated with excess demand. And we'll be able to see our effect on, for example, job openings in real time. So, and that would tell us about wages. Wages are not principally responsible for the inflation that we're seeing, but going forward, they would be very important, particularly in the service sector. So, sorry, I'm not sure I'm getting to your question.
My question is inflation data itself the best indicator for when you're getting to where you need to go, or might it lead you to go too far?
There's always a risk of going too far or going not far enough. And it's going to be a very difficult judgment to make, or maybe not. Maybe it'll be really clear. But we're quite mindful of the dangers. But I will say the worst mistake we could make would be to fail, which it's not an option. We have to restore price stability. We really do. Because everything, it's the bedrock of the economy. If you don't have price stability, the economy is really not going to work the way it's supposed to. It won't work for people. Their wages will be being eaten up. So we want to get the job done. This inflation happened relatively recently. We don't think that it's affecting expectations in any kind of fundamental way. We don't think that we're seeing a wage price spiral. We think that the public generally sees us as very likely to be successful in getting inflation down to 2%, and that's critical. It's absolutely key to the whole thing that we sustain that confidence. So that's how we're thinking about it.
Hi, Brian Chung with Yahoo Finance. I just want to expand, I guess, on what you just said now about the general public feeling like you can get this done. When you talk about consumer sentiment being down, household inflation expectations being up, recession just broadly being dinner table talk, does the general feel among American households and also businesses square with your explanation of the economy, given that the description of inflation in the statement didn't change between May and June? Thanks.
So clearly, people don't like inflation a lot, and many people are experiencing it really for the first time, because we haven't had anything like this kind of inflation in 40 years, and it's really something people don't like, and they're experiencing that, and that's showing up in surveys and in all kinds of ways. And we understand that, and we understand the hardship that people are experiencing from high inflation, and we're determined to do what we can to get inflation back down. So that's really what we're saying. Clearly, it's an incredibly unpopular thing, and it's very painful for people. So, but I guess what I'm saying is the really critical question from the perspective of doing our job is making sure that the public does have confidence that we have the tools and will use them, and they do work to bring inflation back down over time. It will take some time, we think, to get inflation back down, but we will do that.
Chris.
Thank you. Chris Rugaber at Associated Press. You have talked about inflation a few times and mentioned oil prices, China lockdowns. But aside from rises in commodity prices such as gas prices, we're also seeing stickier measures of inflation increasing, such as the Cleveland Fed's median and trimmed mean CPIs. I mean, how persistent do you see those underlying measures of inflation, and how do you expect and where do you see those going in the near future?
Yeah. So, as I mentioned, I think in my opening statement, the inflation has started off in quite narrow, very directly pandemic-related areas, and it's spread now broadly across the economy and into the services sector as well. It was really in the goods sector at the beginning. In particular, you're seeing in travel now, if you've flown on a plane lately, planes are very full and plane tickets are very expensive. some of that will be passed through of energy prices, but it's so you're experiencing services inflation. Shelter inflation is high. So the question, and you see the Cleveland measure going up, and many other measures are going up. So it's a time when we're not seeing progress, and we want to see progress, and that's really another part of why we did what we did today, and why the SEP looks like it does, is that we see it as appropriate to get the policy rate up to restrictive levels, which would be, in the thinking of the committee, somewhere in the range of 3 to 3.5% by year end, and then after that, you see what the rest of the SEP says. So I hope that's responsive to your question.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Do you still think a softish landing is possible, and how would you define that at this point, considering the revised projections for unemployment, GDP, inflation?
So I think what's in the SEP would certainly meet that test. If you see, you're looking at getting back down to almost a 2% inflation by 2024, and the unemployment rate is still as low as 4.1%. That would be, I would call that as meeting that test. Do I still think that we can do that? I do. I think there's. I don't want to be the handicapper here. That is our objective. And I do think it's possible. Like I said, though, I think that events of the last few months have raised the degree of difficulty, created great challenges. And again, the answer to the question, can we still do it, there's a much bigger chance now that it'll depend on factors that we don't control, which is, fluctuations and spikes in commodity prices could wind up taking that option out of our hands. So we just don't know. But we're focused on, very, very focused on getting inflation back down to 2%, which we think is essential for the benefit of the public, and also to put us on a path back to a sustainably strong labor market like the one we had before the pandemic.
Greg.
Thank you. Greg Robb from MarketWatch. Chair Powell, I was wondering if you could talk a little bit more. Economists are worried that you're kind of hitting the economy with a sledgehammer, and that now there's even more risk of a recession than a 50-50 path of rates. So could you talk a little bit more about that, and what evidence would get you to stop rate hikes and maybe even reverse them?
Sure. So, as I mentioned, financial conditions have tightened over the last 7 months, and that's a good thing, we think. But the federal funds rate, even after this increase, is at 1.6%. So it's hard to see how that is too high of a rate. And even if we did another, we're going to get here by the end of the summer somewhere in the 2s probably. Still, that's still a low rate. So that's not a rate that is calculated to bring a recession on. And by then we'll have seen a whole lot more data. As I mentioned a couple times, the committee's views are around a modestly restrictive stance, which would be in the 3 to 3.5% range by the end of this year. But that's conditioned on that being the appropriate thing to do. If we see data going in a different direction, it'll be reflected in our policy, as you see today. We'll be watching if things go in a direction we don't expect, then we're going to adapt. And I would say this is a highly uncertain environment, extraordinarily uncertain environment. So again, we'll be determined and resolved, but flexible.
Hey, Evan.
Evan Reiser, Market News International. Thank you, Chair Powell. I was wondering if the Fed has initiated a review of the conduct of monetary policy over the last 2 years or so, given the inflation, and will that be shared with the public? And then secondly, given the illiquidity and extraordinary volatility in financial markets, are you concerned that QT will make that worse?
Sorry, what was your question on QT?
Just given the illiquidity and extraordinary volatility in financial markets, whether QT will make things worse.
So, of course, we've been looking, very carefully and hard at why inflation picked up so much more than expected last year and why it proved so persistent. it's hard to overstate the extent of interest we have in that question, morning, noon, and night. So, but you have to understand the context. Really, the context is this: for decades before the pandemic and the reopening, you had a world where inflation was dominated by disinflationary forces such as declining population or aging demographics, let's call it that, globalization enabled by technology, other factors, low productivity. So, and that's how all the models work. It is decades and decades of data. They look at that. It's a very flat Phillips curve work, and the supply shocks tend to be transient, right? So we have now experienced an extraordinary series of shocks, if you think about it. The pandemic, the response, the reopening, inflation, followed by the war in Ukraine, followed by shutdowns in China, the war in Ukraine potentially having effects for years here. So we're aware that a different set of forces are driving the economy. We have been, obviously, for quite a while, that these forces are different. Inflation's behaving differently. And in our thinking, it really is a question of very strong demand, but you couldn't get this kind of inflation without a change on the supply side, which is there for anybody to see, which is these blockages and shortages and people dropping out of the labor force and things like that. So that's how we're looking at it. And we've done a lot of work internally on and thinking about what all that means. The thing is, you don't know whether those forces are, what extent are they going to be sustained? In other words, will we go back to a world that looks a little more like the old world, or are we really going to be in a world where major supply shocks go on and on? The history is you see these waves of supply shocks, as you did in the 70s, and then they go away, and sort of there's a new normal and things settle down. But honestly, we don't know what that's going to be. In the meantime, we have to find price stability in this new world and maximum employment in this new world where clearly inflationary forces you're seeing them everywhere. Again, if you look around the world at where inflation levels are, it's absolutely extraordinary. It's not just here. In fact, we're sort of in the middle of the pack, although I think we have, of course, a different kind of inflation than other people have, and partly because our economy is stronger and more highly recovered. So that's what we're doing. We've done a lot of introspection and work on that. And sorry, on QT, we've communicated really clearly to the markets about what we're going to do there. Markets seem to be okay with it. We're phasing in. Treasury issuance is down quite a lot from where it's been. So I have no reason to think, markets are forward-looking and they see this coming. I have no reason to think it will lead to illiquidity and problems. It seems to be kind of understood and accepted at this point.
Thanks. For the last question, we'll go to Mark.
Mr. Chairman, Mark Hamrick with Bankrate. Wonder what your assessment is about the outlook for the housing market, given the years-long increase in home prices and now the sharp rise in mortgage rates. And all that, of course, given the heightened sensitivity around the housing market, given the fact that it was a trigger for the great financial crisis over a decade ago. Thank you.
Sure. So rates were very low. A good place to start is that rates were very, very low for quite a while because of the pandemic and the need to do everything we could to support the economy when unemployment was 14% and the true unemployment rate was well higher than that. So, and that was rates are low, and now they're coming back up to more normal or above levels. So. In the meantime, while rates were low and while demand was really high, obviously demand for housing changed from wanting to live in urban areas to some extent to living in single-family homes in the suburbs, famously, and so the demand was just suddenly much higher and low. So we saw prices moving up very, very strongly for the last couple of years. So that changes now, and rates have moved up. We're well aware that mortgage rates have moved up a lot, and you're seeing a changing housing market. We're watching it to see what will happen. How much will it really affect residential investment? Not really sure. How much will it affect housing prices? Not really sure. It's, obviously we're watching that quite carefully. You would think over time, so there's a tremendous amount of supply in the housing market of unfinished homes. And as those come online, whereas the supply of finished homes, the inventory of finished homes that are for sale is incredibly low, historically low. So that it's still a very tight market. So prices may keep going up for a while, even in a world where rates are up. So it's a complicated situation. We watch it very carefully. I would say if you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together, and where inflation is down low again, and mortgage rates are low again. So this will be a process whereby we do our work in a way where the housing market settles in a new place, and housing availability and credit availability are at appropriate levels. So thank you very much.
Well, shit, that was a lot. Oh boy, that was a lot, man. Y'all still here? What's poppin', everybody? All the new people that's in here. I'm Lando Success. We are covering the Fed meeting. I'm gonna give my thoughts. Before we do, we gotta pay the bills. So we gonna first pay the bills with Moomoo. Shout out to Moomoo. You need to get you 10 free stocks. Right now, they're doing a promotion from like middle of July to the end of July where you get up to 10 free stocks. I got it pinged to the top of the comment. You get 1 free stock just by opening up an account. You get another free stock. We actually get 5 free stocks once you just literally deposit $1. $1 make you holla, and you're going to get some more free stocks. Shout out to Moomoo, link in the bio and all that stuff. And the second person, you can't forget about your boy, myself. We actively have my Patreon going. People have been asking, Orlando, when you going to finally start doing a Patreon? I started one in June, and the feedback is great. People love it. We are starting with the basics right now, and we're going to slowly but surely just keep turning things up to the next level. It's only $20. If you don't want to do $20, you get the free YouTube videos right here. But here you get more VIP access to all the good stuff that's going on. We do monthly giveaways, give away free money, give all type of game. I like the Patreon style because I don't have to edit my videos and hey, like and subscribe and all that type of stuff. I get to just wake up, boom, give y'all that raw stuff and get it. So what's my thoughts? First thing first, when Jerome Powell came out, take the glasses off for a second. That light bright as hell. First thing first, when Jerome Powell came out, he was nervous as hell. This is the first time I literally seen Buddy from beginning to end when he was speaking at first before the questions happened. He was scared, man. Well, he looked very nervous, in my opinion. And he came straight forward and addressed the elephant in the room. Started off, hey, man, everything is a little messed up right now. We need to fix it. We chose last minute to go from 50 to 75%. I like the questions at first. The questions started off hot, like, yo, what we need to do, what's going on? I like the questions originally. Then they calmed down and let him get in his swag. And once he got in his bag, it was easy for him. And then at the end, it finally started picking back up to ask about the housing market. And I noticed the way he started to answer the questions, right? After a while, he just stopped giving a damn and was like, look, let me tell y'all, the real deal is there's some things that's outside of my hands that can't handle inflation. Even though it's a deflect, it's an honest deflect. For example, he like, look, gas prices, I can't help gas prices. That WAR Ukraine, I can't do anything about it. So it's like, yo, there's certain things that's out of my hands. And, you know, I like some people basically pull this card like, yo, in this meeting, you said X, Y, and Z. We're here. What's up? And he like, yeah, you know, I did say that. I didn't expect X, Y, and Z to happen. I didn't expect gas prices and things to go up. Now, the market responded all over the place. First, the market was like, yay, oh man, this is great. Yeah, go up. Then the market just crashed real quick and just dipped all the way down. And it's like, oh, he must have said something they didn't like. Then it came back up like, yay, and went higher. So the market is completely mixed. We're going to check it out in a second. Overall, because my thing is going into this, what I wanted was more transparency and just honesty, because every single one of these we have done so far, after it's over with, it's like, bro, he just went there and lied for an hour. Just a bunch of lies. Just lies. At least now I can say it's 30% lies, 70% the truth. And then he's like, went to the data. It was like, oh yeah, we're going to start going to the data. And I'm looking at the data. And he was like, yeah, we took this sentence out because once we seen some new data about inflation and all this type of stuff, we changed it. How the hell you're Jerome Powell and you don't get the data? Because I could have told you that. I seen the CPI report. I covered the CPI report on the channel, and I seen the data and everything is complete shit. So it's like, make that make sense. It's like, oh, now we want to look at the data. So he was very data centric in this one. Like, okay, now instead of him basically giving everybody false hope and okay, everything is going to be perfect and all happy. Now this one, it was more of, let's look at the data and we will decide on if we want everybody to be happy and friendly. The reason I think the market actually responded in a positive side of it, basically moving up, is because we just needed this shit to be over with. We've been getting beat up so much. At this point, it was nothing Jerome Powell could do to really mess the market up even more. We just needed you to just be 100. All right, you was going to raise it 50-point basis. All right, we switched it up 75. Everybody knew 75 like 2 days ago. That's been like the rumor. So it's going to be 75. So it's like, all right, you switch it up where it's like, okay, we're going to raise it a little bit higher. But nobody is like fearful of it. Everything he said, we already knew. We knew gas prices high as hell. We knew people spending their money only in a certain area, a selected thing. People are being more tight with the money. We already knew because we out here every day living it. So overall, I couldn't have that brother job. I wouldn't want his job. It don't look too sexy, man. Let me know what y'all thoughts in the comments. We're going to look at crypto market. We're going to look at the stock market. I know people going to say, is it time to start back investing and all that type of stuff? If you're new in here, hit that like button. Hit that subscribe button. I appreciate it. I prefer to buy more expensive and not lose like in crypto. What you talking about, player? I am going to get to the point. It's going to get to the point where the only way you can get a home is to inherit one from your parents or sign a 100-year mortgage. So that was very Did y'all hear at the end, yo? Did y'all hear buddy at the end just basically say, if you looking for a home, don't buy one right now. Just wait till shit calm down. Was I'm the only one that hear that?
Oh my God. They took my job.
I know I'm not the only one that heard that. He like, hey, don't do it. Nope. We are screwed. So buying a home this time. Oh, well, okay. So y'all heard it. Okay. So I'm reading the comments late. So yeah, y'all definitely, I got to do a separate video on that alone. Like, damn, pal. Yeah, shit. Yeah, I don't think he supposed to say it, that one. We got to check out Zillow prices. Have you seen prices of homes nowadays? It was with this inflation nation, baby. I'm Lando. We are all Lando. What's up, player? What's going on? Yeah, he definitely looked nervous. Buddy was shaking his fucking hands. Oh my gosh. I bet he was getting death threats. Yeah, he probably was getting them. I wouldn't want that job. The reason I wouldn't want the job is because I'm goofy, where it's like, okay, even if I'm nervous, let me try to crack a joke to break the ice. And with that job, you can't crack a joke Because I just would have walked out and be like, everybody, the market going to hell. That's all I get. And turn around and walk away and come back out like, I'm just bullshitting with y'all. But the market would like crash and tumble 3,000 points. Like, oh, Orlando said the market gonna crash. And, so you can't technically do that. And I'm not about to be nervous to tell somebody what it is. Only reason I'm nervous if I know the truth and I got to go lie to y'all. That's what I'm not good at. If I know the truth and y'all want me to lie and make me try to believe this lie even though I know the truth, that ain't gonna work out good. So I wasn't bad to do it. He needed to rip the Band-Aid off. We're already in the middle. Like, bro, yeah, we're in a freaking recession right now. We see it. There ain't no need to sugarcoat and all of this type of stuff. You know how people are. We've been in recession longer than been alive. Literally though, like really, that's the funny part. When they ever going to call it a depression? Not yet. He keeps mentioning price stability. It ain't no price stability. Ain't no price stability anywhere. So home prices are jumping to 1 million standard. Yep, sound about right. So let's look at the market and see what's going on with everything. Jeez. Oh man. First start with crypto. Let's go to let's where my CoinGecko linked together. Let's see. Oh, there we go. All right, let's see. This is all of the DeFi stuff on the MMF system. So you have the last hour. M shares finally decide to come live, all the way live, heavy. Savannah Finance went from 1 cent to 2 cents, player. Look at that. You know how bad they've been getting beat up? For you to literally go up 47% in 1 hour, 82% in 1 day, but still be down 28% in a week. That's the funny part. You got Luna is up. But the problem is, it's been like default. It's been trading like flatline for the last week. So, yeah, leave that alone. I wouldn't mess with it. Then, the people that's in my Patreon, I have a list of stuff that we are actively buying. Let's see what's that. We got Cardano is up right now. Solana is up. Solana then went past the went back over 30. When we started this live, Solana was at 29. So everybody is reacting good. You got Crow about to hit 12 cents. Polygon is up almost 10%. And that's all within the last hour, not in the last week. Zilliqa, 8%. Everything red, man. Yeah. So the market reacted good to it. When we started this live, it was at negative 7%. We ended, in the green, man. This is good. The market responded good. Hey, like, okay, we ripped the band, like you said, we ripped the Band-Aid off. Now let's move forward. Question is, how long is this going to last? I don't know, people. I don't know. But, my rule of thumb is don't buy if it's not red in the last 24 hours. You can veto that thought right now because prices is too low. So if you want to buy right now, you still can buy. Should have bought before the meeting. But look at this. So in the last 7 days, say Bitcoin's 30,000, right? You can take my rule of thumb and throw it away right now because we close to 20,000, so you'll be okay if you decided to buy something in right now. Patreon members, y'all can buy in right now today if you want to. Let's see what y'all talking about in the comments. Toxic Deer crash yesterday. Gotta check them out. People were swing trading tokens since it was small cap like MMF. The swing traders caused it to depeg and kill. Okay, so that's what happened. Because I was wondering, like, what the hell happened? Because it just was, I was trying to see on Reddit for anybody to break down, like, why that shit was just flatline. So you said people were swing trading its tokens since it was small cap like MMF. The swing traders caused it to depeg and killed the token. Jeez, I ain't seen nothing like that one. Now I bet Bitcoin would go up. People need to be comfortable to bug in. Yeah, man. But what I'm about to do is a few videos. I'm probably about to do a quick recap video. I'm not going to do my crypto.com video today. I'm going to still go out and go make some more money. If you haven't watched all my videos that I recently did, check them out. I appreciate all of you guys. I'm surprised my camera made it all the way through. We are at 1 hour and 39 minutes, almost 40. Any luck with your Coinbase rewards? Gained about $500. That's a win. Damn, Ape is up 23%, people. Like I said, it was good. Like, I'm not an ApeCoin person, but I would have bought that ApeCoin dip because it's a quick money grab when it shoot up. You can buy and sell, but you know, that's a whole different thing. So I appreciate all you guys. Hope all is well. This is a song by my boy Najee Nomadic. He haven't released it yet, so that's the reason why I'm playing it right now. So Najee, you gotta release this. Run down. Shout out to that player.
Won't you give me the rundown? Let me know how to love now.
Release new music. Go to his IG and tell him to free new music. Nomadic.
Write a chapter in my script. Tell a secret on my lips. Find out just how I like it. Yeah, yeah. When do you think we could link? Why don't you ring my phone? I don't need a quick fling, I need the real thing. If you ain't, leave me alone, no. I ain't gonna front you with my good luck. I've been waiting on it days and weeks. You were turning into my baby B. Like, have you ever thought about dating me? Basically,
let's see if I can find him on IG.
Girl. How you waking up thinking who you, girl? Bourbon Street, you a voodoo girl. Hide and seek, I don't wanna lose you, girl. 9 in the clip, 5 in the seat, 1 in the head.
My wife hate when she open my IG. All you just see is ass and just good looking.
You can ask them niggas if they stupid, girl.
In sports.
Let me know how to love now. Let me know how to trust you. Show me nothing else but you.
Look, I follow a bunch of good looking women.
My crib. Write a chapter in my script. Tell a secret on my lips. Find out just how I like it. Yeah, yeah. Won't you give me the rundown? Let me know how to love now. Let me know how to trust you. Show me nothing else but you. Won't you come back to my crib? Write a chapter in my script. Tell a secret on my lips. Find out just how I like it. Yeah, yeah. Girl, you know I rock the boat, baby. Bills paid, I'm responsible, baby. Cure you if you got to go, baby. Lay down in my hospital, baby. I'm good as you ought to know. I'm unstoppable, they don't got to know, baby. We'll be somewhere tropical, baby. Playing so diabolical, baby. Oh, fatty on the island, fist full of diamonds. Never met a nigga this solid. When I woke up, I chose violence. Never lacking, baby,
there
I got it.
Nomadic music.
They only wanna wipe that cook. They only wanna wipe that clean.
Go tell Nomadic to free his new music. Tell him Lando sent you. Najee, free your good music. Tatty your shit.
Come back to my crib. Write a chapter in my script. Tell a secret on my lips. Find out just how I like it. Yeah, yeah. Won't you give me the rundown?
Appreciate you guys. I'm Lando Success. I'm your host today. I hope all is well. Talk to y'all beautiful people later.
Tell a secret on my lips. Find out just how I like it.